السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.
I know many of you have seen a lot of videos on chart patterns on YouTube and how to trade them. But most of these videos don't tell you why you should trade them and in fact why these chart patterns actually work in the market. So this is going to be one of the most comprehensive courses on chart patterns out there. Many professional traders even sell paid courses on chart patterns that are worth thousands of rupees with very little content. But guess what? This course is completely free of cost and is exclusively for educational purposes only. So share it with all your fellow traders and friends. And if you are new to the channel, consider subscribing to the channel and also enable the bell icon so that you won't miss out on any upcoming videos.
The wedges. We will start off with a rising wedge. A rising wedge is a popular bearish pattern. This pattern starts wide at the bottom and then contracts as the price moves upwards, and the trading range gets smaller towards the top. This pattern forms when the price consolidates between upward sloping support and resistance lines, where the slope of the support line is much more steeper than that of the resistance slope. What this implies is that the higher lows form much faster than the higher highs, leading to a wedge-like formation. This also means that the selling activity is gaining more traction and the buying activity is getting weaker. Also, the contraction of the trading range from left to right indicates a weakening of the existing trading activity. But the rising wedge can be one of the most difficult chart patterns to accurately recognize and trade. While it is a consolidation formation, like most other patterns, the loss of the upside momentum on each successive swing high gives the pattern its bearish bias. However, the series of higher highs and higher lows keeps the traders guessing that the trend is still bullish. This is where the contracting range helps us the most. Moreover, to identify it as a rising wedge, the price should test the upward sloping support and resistance lines at least twice each. Now, a shocking fact about rising wedge pattern is that it can be both a reversal or a continuation pattern. Now, it depends on its position in the price chart. But the more important information is that regardless of the pattern being a reversal or continuation in nature, rising wedges are bearish. This is what we will focus on. The added advantage is that we can spot this pattern at the end of an uptrend or as a consolidation due to a short-term profit booking during a downtrend. But actually, the bearish confirmation of the pattern does not come until the upward sloping support line is broken in a convincing fashion. Ideally, we expect the volume to decline as the prices rise and as the wedge forms, and there should be an expansion or rise in volumes on the support line break, which can be taken as a bearish confirmation. Now, you can also use momentum indicators like RSI or MACD to spot the shift in momentum. Anyways, when the price does break the support line convincingly, our bias is always towards selling on the breakdown. With a consolidation in prices, traders know that a big slash is on its way, so they expect a breakout either to the top or the bottom. So when the rising wedge is formed after an uptrend, it is referred to as a bearish reversal pattern, but if it is formed during a downtrend, it could mean a continuation of the down move. Now that we have learned how to identify a rising wedge, we can discuss how to trade the pattern. So I will discuss the entry methods, where to place the stop loss, and how to set the targets. Now starting with the entry criteria, as it is a bearish pattern, we are only interested in the break below the upward sloping support trend line. You can take a short entry following a breakout of this level, that is, you can enter at the moment when the price breaks below the support trend line, or you can look to sell below the low price or even at the closing price of the breakout candle after it closes. The second method is to wait for a pullback or retest back to the breakout level and then take a short entry when the price moves lower or when the price moves below the breakout candle low. Now you are probably wondering, which one is better? Well, there is no best approach. If you enter at the break of the lows, it could be a false breakout, but if it is a real breakout, it is the best possible price you can get. Alternatively, if you wait for a close below the lows, then you will reduce the chances of a false breakout. But if the breakout is too strong, you will end up entering at a much lower price. The same is the case with waiting for a pullback or retest, which may not happen often if the market is trending strongly, and as a matter of fact, you will miss out on the trade completely. So it is up to you to decide the entry strategy and continue practicing it over a large number of trades. It is always recommended to confirm the validity of the breakout using volumes and other momentum indicators. So a higher than average volume can validate a breakout most of the time, as it shows the interest of the market participants, and low volume breakouts are most likely to fail. Also, using momentum indicators like MACD, RSI can also help you identify a true breakout. I have made videos on all these topics, so you can check them out. Let's now focus our attention on the criteria for setting the stop losses. How to set your stop loss when trading the rising wedge pattern. Now, you don't want to set your stop loss at obvious levels like support and resistance, swing highs or swing lows, etc. And why is that? Because you will get stop loss 100 easily. Because these are as obvious a level to you as it is to others, including the smart money. So, how do you get a proper stop loss setup? And it's very simple. As I have mentioned over and over again, your stop loss should be at a level that, if crossed, invalidates your trading setup. So we are trading a rising wedge pattern here, and the pattern is invalid if the price breaks and closes above the top trend line resistance. So you have to keep your stop loss above this resistance level. So there are still chances of long wicks which can take out your stop loss and then move in the desired direction. So to be extra safe, you have to give your trades more breathing space by setting your stop loss some distance away from the market structure using an indicator like ATR. So you have to set your stop loss 1 ATR above the most recent swing high level. Let's learn how to set a target for the rising wedge pattern. Now there are many ways you can cash in your winners. And one of the most common approaches is to have a predetermined profit target. Now the target can be measured by taking the distance of the back of the wedge, or the widest portion of the wedge, from the support to the resistance level, and then extending this distance down from the trend line breakout point. You can also choose to trail your stop loss until the market takes you out of the trade. Now why is this a better option? Think about this. The rising wedge pattern usually appears in a downtrending market or at the end of an uptrend. In such conditions, there is a lot of potential for the trend to continue, and the only way to ride it is to trail your stop loss. Now, to trail your stop loss in the best possible manner, you can use moving averages or Chandler stops and only exit the trade if the market closes above it. Moreover, it is much better if you use a combination of both the price projection method and the trailing stop loss method, so that you can gauge the move using the price projection method so as to lock in part of your profits there and then ride the rest of the position using a trailing stop loss, thereby not impacting your psychology and avoiding any losses due to reversals. Now moving on to the final chart pattern of this video, the falling wedge. Falling wedge chart pattern is like a counter pattern to the rising wedge. It is created when a market consolidates between two converging support and resistance lines. For a falling wedge, the support and resistance lines have to point in the downward direction, or they should be sloping down, and the resistance level have to be steeper than the support level. The pattern generally starts wide at the top and contracts towards the bottom as the price moves lower. This sort of price action forms a cone-like shape that slopes down as the swing highs and swing lows converge. As the price continues to slide down, it will lose momentum, and it signals that the buyers are beginning to step in and are slowing the rate of the price decline. Now, in contrast to patterns like symmetrical triangles, which have no definitive slope or bias, the falling wedges should slope down and we have a bullish bias. Now, as with rising wedges, the falling wedges is also one of those challenging patterns to trade. The falling wedge is seen as both a bullish continuation and a bullish reversal pattern, which give rise to some confusion in the identification of the pattern. Now, both scenarios contain different market conditions that must be taken into consideration. But the differentiating factor that separates the continuation and reversal pattern is the direction of the trend when the falling wedge appears. A falling wedge is a continuation pattern if it appears in an uptrend, and it is a reversal pattern if it appears in a downtrend. However, this bullish bias cannot be realized or confirmed until the downward sloping resistance line breakout occurs convincingly. By convincing, I mean the volume should decline as the pattern progresses from left to right, or simply the volume should contract with contracting prices, showing a weakening of the existing price trend, and the breakout above the resistance line should be accompanied by higher than average volumes, indicating a rise in the interest among market participants. Now you can also make use of momentum indicators like RSI, MACD, etc. to confirm the reliability of the pattern. Now we will talk about the entry criteria. So how do you better time your entry? The first approach is to go long when the price breaks above the resistance trend line. All you need to do is to place a buy order above the resistance line and you will be immediately long when the price breaks out above the level. And if the breakout is real, this is one of the best prices to enter. But this is a very risky method and chances are it might be a false breakout. Now this next method is similar to the previous approach. The only difference is that you wait for the price to break and close above the trendline resistance. You can take a long entry above the breakout candle highs once the candle closes. Now this will reduce the likelihood of a false breakout, but if the price momentum is strong, you will enter your trade at a much higher price. Now if you are an experienced trader, then you can even enter the market as the price pull back or retest back to the upper trend line of the pattern. This can help you enter the trade even if you miss the breakout move, and it offers a better price entry than waiting for the close of the breakout candle. But the issue with this approach is that market may not give a pullback or retest every time. So once again, you can choose the entry type that you like based on whether you are conservative or aggressive in your approach. But make sure to validate the breakout with volumes and other momentum indicators to see if there is actually an interest in the market participants to take the prices higher. Now how to set a proper stop loss so that you don't get stopped out too early. Now it doesn't matter whether you are trading breakouts or pullbacks because the concept is the same. Your stop loss must be at a location that if breached will invalidate your trading setup. This means if the market hits the stop loss, you will automatically know that you are wrong. So a stop loss below the resistance level is not a good idea. Where else then? Think about it. Where is the ideal place to set your stop loss so that if the market reaches it, you know the falling wedge pattern is invalidated. Since the pattern forms higher swing lows and if the price moves below the recent swing low or break below the downward sloping resistance trend line, then we can be sure that our analysis was wrong. So this is exactly where you need to keep your stop loss, that is just below the swing low or the support level. Now you can give the price some breathing space by adding one ATR buffer below the recent swing low or the support. I hope this is clear. Now how to cash in your winners? Now, one of the most common approaches is to have a predetermined profit target. Target can be measured by taking the width of the top of the wedge or the widest portion of the wedge from the support to the resistance level and then extending this distance upward from the trendline breakout point. You can also decide to trail your stop loss. Now, the trailing stop loss helps you ensure you ride the entire trend. Now, to trail your stop loss in the best possible manner, you can use moving averages or Chandler stops and only exit the trade if the market closes below it. And if you are using the moving averages, use 20, 50 or 200 period moving averages depending on whether you have a short-term, medium-term or long-term trade objective. Moreover, it is much better if you use a combination of these two methods so that you can gauge the potential of the move beforehand using the projection method so as to lock in part of your profits there and then ride the rest of the position using the trailing stop loss method, thereby not impacting your psychology and avoiding any potential losses due to reversals. Now that is all the major reversal patterns in a single video. In the previous two episodes, we have discussed the most important continuation and reversal patterns, how to identify them, and how to trade them in a very detailed manner. When dealing with both continuation and reversal patterns, we have a clear idea or maybe we have a directional bias towards where the breakout will happen. That is, in the case of continuation patterns, we will look to trade in the direction of the previous trend before consolidation. And for reversal patterns, we will look to initiate trades in the opposite direction of the prior market trend. But the third type of pattern that we are going to discuss doesn't have a directional bias associated with it when it comes to the breakout or the trade direction. Or in simple terms, the breakout of the pattern can be in either direction, and we cannot judge the direction of the breakout before it happens. This category of chart patterns is called as neutral chart patterns or bilateral chart patterns. Since we cannot be sure of a possible breakout direction, these patterns can be dangerous because of false breakouts. More often than not, you will find yourself entering a breakout above or below the pattern consolidation only to see yourself fall prey to a false breakout. I have already made videos on breakouts and false breakouts in my price action course. You can check those videos to know more. In this part, we are going to discuss 3 bilateral patterns, how they work, and how to take trades, including the entry, targets, and stop losses. Now, the 3 bilateral patterns under discussion are: number 1, the symmetrical triangles, followed by the symmetrical expanding triangles or broadening triangles, and finally channel patterns, that is rising channel and falling channel patterns. If this series of videos are helping you become better at trading, then please do like and share this video and support our efforts to build a healthy trading ecosystem. So let us start our discussion with
السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.